All right, welcome back to the Denny Artache Show. My next guest here, he doesn't like to brag about himself, but let me tell you something, folks. Paul Meeks is about as good as it gets when it comes to money management. He's a chartered financial analyst. He's with Independent Solutions. I'm so happy and glad to be partnered with him. One of the reasons I formed Artache Financial Group is so that I could do things like what the private wealth group does at Independent Solutions, 1031 exchanges, opportunity zones. Now, Paul, you can see him on CNBC most every week, and he's known for running the largest technology fund in the world. But Paul doesn't just do that. He really keeps his grip on the market. He has a dividend portfolio. And like me, he's a little bit concerned about some of the things that are going on. I don't want to. And Ron, you should have Paul managing your money. I'm just trying to tell you, no pressure. But I want an answer by the end of the show. Paul, are you there with us, sir?
Yes, sir.
All right, great to have you as always. So, Paul, wow, since last we spoke, there's some interesting moving parts going on. So, what is your take, A, on the economy? B, on what the market looks like in the next 6 to 12 months, and also what you may think is in favor for investors that might be a little scared of corrections coming forward.
Sure. First of all, appreciate the intro. You should be my agent, and I'll send a cut of the action over.
Hey, done. I'm in. You don't have to tell me twice.
Sure. So, as for the economy, I'm still pretty constructive and more constructive about what's happening in the U.S. Vis-a-vis developed international economies or emerging market economies. The thing that worries me the most, and it's worried me for some time, and I still think that the jury is out on it, is inflation. Now, inflation is present. There's no question about that. Nobody argues. Last month, the month of October, the consumer price index, probably the best to gauge for consumer price inflation, was 6.2% up.
Ouch.
That means 6.2% up between October 2020 and October 2021. Wow. And that's about 3x the level pre-pandemic.
Yeah.
So I would tell you, if it is structural and not transitory, that's a problem. And that kind of directly answers your question. That would have me worried, probably real worried. But the conventional wisdom is, and what's being promoted by the people in D.C., particularly the Federal Reserve Board, is that, yes, this is caused by a not just U.S., global supply chain clog. And as we get through the pandemic, it's going to become unclogged. Yeah, I hope so, because that's a pretty big deal.
I mean,
and I do think
I'm still not sure what the problem is with the supply chain. Why are so many ships waiting to unload the supplies? What's causing that?
That makes no sense to me. It makes no sense to me.
It's quite bizarre, because you think about it. What happened in the spring of 2020? The pandemic, impacted, at least in the U.S., so swiftly that the U.S. economy, largest in the world, $22 trillion in 2019, contracted by about a third in about a month. And so what happened, it was so swift and it freaked out so many companies that they thought, oh, this is not a spring 2020 thing. This could be a pandemic that lasts a long time. This could be 1918. And so what they did is they shut down operations, sometimes voluntarily, sometimes because, they weren't allowed to go back to work, padlocked buildings. And so when you shut down the machine, it is so hard to restart it. And you would think, okay, Paul, it's a year later. Come on, man. Well, still, it is still difficult, particularly because our supply chain is global. And so it's not, we're opening up a factory in Iowa. We're opening up a factory in Iowa, but it has a supply chain that goes to Vietnam.
Right. Some of these politicians go, oh, well, we have a simple solution. Just buy made in America products. I'm like, yeah, sure, buddy. We're just going to flip that switch and change everything.
The world these days is, depending on where you are in the political bent, it's global if we like it or not. I mean, that ship has sailed. It's a global world. Always will be.
So here's the thing. look, I believe inflation's not a quick, it's not going to be gone next month. But the other thing is, what is the latest on GDP forecast? Just about 4 months ago, we all thought GDP could still be at around 6%. How do they feel now on GDP? Because we have the potential of a recession.
Well, I don't think we have a potential of a recession, which means we go into contraction mode, like the GDP is negative.
Okay.
And specifically negative for at least 2 quarters in a row. That's the definition. But yeah, you're right. Inflation is starting to rear its head, and it's definitely slowed the prospects for growth. And so I still think that will be better than an average year. A kind of advanced, mature economy like America's, you would expect GDP to be about 2 or 3%. It's kind of how it was for eons and eons. But it'll be better than that this year. But yeah, it's being impacted by the stuff that we just mentioned. And also, of course, after the big pop coming out of COVID, we probably should at some point get back to that slower, mature rate. And then you think about, if we go back to that slower, mature rate, can stocks hold these valuations, which are pretty steep right now?
And will monetary policy stay where it is? Will they raise short-term interest rates? Will they try and stifle this inflationary problem that we're having?
Well, I think what happens is, so the Fed has been buying government bonds, and when they buy government bonds, they support our economy by injecting funds into the economy. So we know that they're tapering that program, and so when I say taper, cutting it back, and so they'll finish buying bonds if they continue the taper about a year from now. That program will wind down about a year from now if they stay on the monthly taper.
Okay.
And then at that point, a year from now, is probably the first time that they'll consider raising the Fed funds rate, the benchmark interest rate, a quarter point. Right now it's 0. And so it's coming. They'll be raising rates probably about a year from now, unless the economy weakens further, which I don't think it will. And then we have to worry about it, because you think about all these years since the financial crisis, which goes all the way back to the fall of 2008, we've had essentially 0 rates.
Yes.
And when you have 0 interest rates, any asset price goes up, whether it be real estate or stocks or bonds. It's great for everybody. And of course, at some point, that hurricane wind at our backs, which has supported us, might become a headwind.
Now, it's interesting. You were bullish on companies like Micron because you said there was a chip shortage, I would say maybe 4 to 5 months ago. Are you still bullish in that sector? Is there a specific sector that you think going forward is a good value opportunity to invest in?
Yeah. Think about there's 11 sectors of the economy, and there are a couple that should do well as rates rise. One would be the financials, because the not investment banks that make money from IPOs, but commercial banks.
Sure.
Because a typical commercial bank will take in some money from a depositor at a low rate, and then they'll turn around and lend it to somebody else at a higher rate auto loan. And so they make money from the spread of rates, low to high. When interest rates go up, you get a steeper yield curve, and those guys can make money hand over fist, because there's a very nice spread between the low borrowing rate and the high lending rate. So banks should do well. I would also say energy should continue to do well, because they are benefiting, with the rocket up in the price of a barrel of oil from this whole COVID madness. And then also various kind of commodity and industrial companies. And then in technology, my sector, it's always based on product stories. And there's always going to be interesting product stories, because they're the innovators. And like last night, for example, America's largest semiconductor company, NVIDIA, ticker symbol NVDA. It's an expensive stock, but I was just blown away by how good their results they reported last night. So I think there's some opportunities there too.
I think sentiment is like, oh, it can't keep going. But I speak to a guy like you to say, well, Denny, the fundamentals are still there. So why wouldn't it keep going?
The key thing won't be the fundamentals, like company A is doing better than company B. or company A story is better than company B, it'll be this phenomenon about interest rates, right? When interest rates start to rise, then we got to have a different conversation. But so far, it's probably at least a year away.
Oh, geez, it's got so serious.
Well, he's good at what he does. I think a lot of sentiment thinks that we may see some corrections and blips on the radar by the first quarter of next year. I mean, there's a lot of things that they're talking about doing. Who knows what they're going to do with the tax situation, if they're going to change that.
Yeah.
And the thing is, Paul, you still think we could see single to low double-digit gains next year unless something major happens, correct?
Yeah, I think I actually do. And I think the next thing to watch, because remember, I don't think rates are going to be increased for at least a year. The next thing, Denny, that's coming down the pike that a lot of Americans don't realize, which I think is a big deal, is the most powerful person, not just in the United States, but in the world in finance, is the chair of the Federal Reserve Board.
Right.
And it's this dude, Jay Powell. And Jay Powell's term expires in February.
Oh, boy.
And he was originally appointed and confirmed by Congress by Trump. Yeah. And so Biden has a very interesting decision to make, and I think he might make it within days. Does he reappoint the Republican Jay Powell for another term at the Fed, or does he go to somebody else? And right now he's contemplating, and I actually would like to see Powell stay because I think he's done a nice job. But if Biden goes another direction, I think the market could get whacked that day. So that could be the next thing to
run, Forrest.
Seriously, such a downer. My God.
Yeah. Well, when I say whack, you talk about things that we can't control that have nothing to do with companies that could impact. Mm-hmm. And when I say whack, the market could have a bad day, and it might actually be a good day to buy. It'd just be a transitory thing.
I mean, look, the fact is, because rates are so low, they can't buy bonds. They have to invest in something. They're not going to go to cash and make no money. That's just not how the world.
Well, you take a look at this year, the S&P 500 is up about 25% year to date. It's going to be another great year,
right?
Mm-hmm. And the average bond in 2021 has a negative number. So, man, you lost money in bonds and you made under 20% in stocks, and usually a good year in stocks is only 10%.
Again, so I think most people say, how can it continue? But if the fundamentals remain, look, I think the other thing, too, that I learned from you, the other part that can really hurt us is wage inflation. When that business owner has to pay little Billy $15 an hour to flip a burger and make ends meet. And the other thing is, a lot of people have not fully come back to work.
No, it's impossible. It's impossible to get service anywhere.
I don't know. And who knows? I know that Fauci is talking about a possible surge in COVID in the winter months.
Oh, no.
And that could really stir up investor sentiment. But you know what? For people with a longer horizon, I don't think we cater to traders. We don't. But people that have a 3, 5, 10-year window to investing, I wouldn't push the panic button. Like Paul said, if we do have a correction, that's probably a good opportunity to buy some of these companies cheaper for the next 3, 5, 7 years.
Yeah, because I think that if we have a correction, it won't be long lasting, and it actually won't be on a percentage basis too steep. And Denny, one of the things I am seeing is I've been kind of poo-pooing international stocks for some time.
Yeah.
But not emerging market stocks, but other international developed nations.
Okay.
Markets that are democratic and, capitalistic like ours. There's some opportunities there. So there'll be some continued opportunity in U.S. equities, but also I think, the equities of some of these, major European countries as well.
Very cool. Always a pleasure. Paul Meeks, he loves good rock and roll music. Last time I got together, I sang AC/DC to him. Because,
nice.
Oh, yeah. Love it.
I'm thinking well, what kind of music does Paul? No, he loves rock and roll.
That's good.
Well, I'm a Jersey guy. So, in my eyes, Bruce Springsteen is about as big as it gets.
That's awesome.
That's awesome. Hey, Paul, always a pleasure, my friend. I'm looking forward to doing more work together. And we're going to take another break and come back on the Denny Artache Show. Thank you.